So yeah, I'm still orienting myself here, changing gears from AMA. This is wow. Okay, orienting myself. Yesterday, Amazon pledged $15 billion for Anthropic. So Amazon, about a month ago, they did $100 billion commitment with OpenAI, ChatGPT creator. And then they just went ahead and think about it for a second. Their stock went up 20% in the last 2 weeks. In stocks, that's a lot. Investors are very happy about that. It will likely result in a little bit of a pullback simply because investors who make 20%, if we take a look at it was low already back here for just February 13th. 25%, there's going to be a lot of people that take profit at that. But that extra money that came in, you can bet your boots that was more than enough to pay Anthropic $15 billion. And the reason for this is because Amazon is getting away from building their own models. They are leveraging models already in existence. Now, Amazon has AI, but so they're not so much for the general user. And so by having these as offerings, I think my perception of this is that Amazon is looking to recontainerize these models and have an offering for users to subscribe to multiple models, and that they are simply partnered up with the model creators to maintain that service. It will be very much integrated with Amazon Web Services, their largest product offering by volume. So I shouldn't say that I don't have any news. That is news within the last 24 hours. Moving on to Google, hopefully. There we go. It's 11:11. Google also rose from a low that it touched all the way back from November, also up 23%. It's almost as if when oil started to drop, tech went up. So we had seen a steady decline with a lot of these assets. Google, Oracle, still in decline. Even Palantir. Well, let's wait for it though. Hello. There we go. Palantir. Downward, but coming up this last 2 weeks, 18%. Nvidia. I don't know if the internet's slow or if it's just a bad day. Nvidia, looking at the last 3 weeks, up 20%. It's as if oil has been declining for the last few weeks. Meanwhile, all of the stocks of the US 30 up 9% overall. This is a sign that there is more faith going into the US economy as of late. I am so torn. I think to myself, whatever the masses are talking about, the upside down is more likely to occur. And right now, people are saying, or I should say, up until this, like during this period here, the world was expecting the crash. And so there were a lot of people shorting the market here because, well, look, it's created a new low. This here is a reversal, the sign of reversal. And because of the need for America to maintain its dominance, there must be a period of abundance. And while I think there will be disruption in the markets, I am quite certain that this period of abundance is upon us. That we will see gold and silver go up because of the demand for chips, but that because of the computing world's increase, there will be a great deal of abundance that's going to be cast down upon all of the peasants as a token of gratitude from the king, really is what it's going to be interpreted as. But that it'll just be the placating, keep them almost like today. Wayne Peters said, "I think I know what's going to wake up Canada," and I was like, "Oh, please tell me that there is hope on the horizon. What is it that's going to work? What is it that's going to be the final catalyst that allows Canadians to wake up?" And he said, "When we go from 6 NHL teams to 4." That made so much sense. If they can get people, America is due for a revival, and the programming language that we're seeing within all of the media coming out of America is that Trump is the savior. And I'm of the mind that he will continue to be painted as such. Things are not going well for him right now, but that on the other side of this, the deal has been made, and that the next phase of this digital onboarding into the Great Reset will be extremely attractive. If you take a look at how Hong Kong has developed over the last several decades, you'll begin to see a similar pattern where Hong Kong was liberated by capitalism. The people of Hong Kong were abundant, they were not before. And then Britain came and liberated them, and they used capitalism to do it. But of course, the terms and conditions ever so slowly wrapped around the throats of all of those entrepreneurs. It is a very effective strategy. I'm of the mind now that if there is a crash, it will be so brief and so obviously a result of good monetary policy that Trump will be absolved of all of the questions that people have of him today. And this goes in line kind of what Archaics was talking about him. The Antichrist would actually be welcomed. because of how much abundance is being provided. So it's going to get better, but in the long run, it'll make it worse. Again, they're just going to be kicking that can down the road. I feel like I'm being very much again a cynic today. It'll be good, like money wise. It'll look really, really good, and I believe this is where I'm going with the cynicism here. I believe that will make Canada look really, really bad. Carney's job is to absolutely destroy the economy of Canada, to cripple it. That's his job. And that he is doing such a good job that the people will beg for the Southern Fuhrer to apply globalism and save Canada. I mean, everybody around the world loves Canada. I was really hoping that I was really, really hopeful, and maybe it'll come back again. I was really hopeful that people would recognize the fraud for what it was and that we would be working towards the other side of this. But I'm recognizing that we are even more recognizing that we are going to have to be building the ideals that we want, and that it will require being in a parallel world and working very, very diligently at ignoring the temptations of the abundance.
To use those temptations, to use that abundance in a way in which keeps us out of their system.
Yes. And again, have that interface. We got to watch The Matrix, because in there they have an interface where they can go in and out of the matrix, right? We are absolutely going to need that, just so that we can be in the world, right? We're not of it, but we will need to be in it. We're not going to be able to help those who are looking for answers if we have secluded ourselves away as hermits, digital hermits, as it were, monetary hermits, as it were. And that what we have set up is perfect for the environment, because to the outside world it will look like we don't have any fears, we're not concerned economically in Canada. And then conversely, it's not like we're going to have in a period of abundance, it's not like we're going to have something out of place. We'll be able to be a chameleon, so to speak. But I think that this speaks to the importance of us having that responsibility of shining that light. Let's take a look at some other things. On the 4 hour chart, silver's been pulling back a little bit. I did not, I kind of figured that if there was to be a pullback, we'll probably find a test here on this pivot point, possibly also one more test of the trend line. If things go extremely well on the short term, we may see silver come back down and retest lower levels. In fact, due to the pattern that we are witnessing now, where this low came down so much lower than this area here. This, oh, let me grab this, I think. Yeah. This area coming down so much lower than it did here. It is entirely possible that this high provides the resistance to the bulls that the bears are able to retest this double top from before. If that occurs, you can bet your boots that the stock markets are going to be doing a big bump. Faith in the dollar, in fiat, goes up when faith in metals go down. If they occur at the same time, it's because the game is up. And supply and demand is actually starting to gain ground over the markets. Because you can bet your boots, if the dollar's going up, the powers that be, the banking system, will want to capitalize on that accumulation. And that suppressing gold and silver will be of its highest, like it'll be have a very, very high incentive to drop to suppress those prices. So they will flood the markets with futures to help bring that price back down. Even gold. Look at how gold is finding such resistance at this level. That was a pivot point after the volatility. That's a major pivot point. This low,
And there's that
lower
pattern.
than there. Yep.
There's that pattern.
This trend line has now been, this short-term trend line, as encouraging as it was, it's been broken. We are now full on into this trend. So this is why it's like, we just might be seeing another sale. And that the retest, the next test, could very well come down to this long-term trend line here. That's for gold. We also have to recognize the role that oil is currently playing. In order for I don't think the price of oil will make a stitch of difference in these projections. That the price of oil will simply be a leverage that nations use against each other. You're going to have producers, people who have secured natural resources like oil, and the resources around it as well. Because when you have, when you've got industry going towards oil, you are bringing other industry with you. There's a lot of benefit to that. As such, yeah, I don't know. This is where I'm kind of lost. I don't know whether or not if Trump if the whole Trump escapade is coming to fruition, where he's becoming a savior, that will require industry. Which means, as much as there will be the one side of the propaganda machine saying that Trump is evil for how expensive everything is getting, the other side will talk about how awesome everything is because of how much money everybody's making. So the price of oil itself it really is neither here nor there. It's about choking out the countries that do not have a source of energy and making them dependent. The Middle East, they're not. They're in no They're in no danger whether the price goes up or down. Japan, though, Japan is very much affected by that. It's kind of like what I was saying yesterday. It very well may be that the Japanese the Asian markets move their headquarters to a country that has the ability to be an energy producing country. Because if you
Like
don't
their
have
friends
energy,
Russia.
sorry, go ahead.
Like their friends Russia.
Yeah, 100%. They're gonna have to. Otherwise, the Asian markets, like China, will just absorb it, being a producer leveraging Canada. You can. I'm honestly of the mind that the reason the underlying reason for Carney is to get the people to beg for Trump. I really believe that. Remember, Trump started his campaign to bomb Iran with language patterns that said Canada can become a 51st state. He dropped that topic within a month, and it still lingers today. Even the Alberta separatist movement cannot toot that horn loud enough.
It's, as you say, it's Trump as a savior being promoted with hopium that he will step in and make everything all better. Thank you, Dad.
Yeah, and that is no longer just a QAnon narrative. Right now, it's spread. Into the digital coins because that is where all of this is being flowed. Bitcoin dominance eked out above that 60% line. That is significant. That is very significant, creating a new high even. It's hard to say where the next I'm tempted to say right here is where we're going where we would see some resistance next. 60.5%. And these seem like such minuscule numbers. Like right now, it's at less than 0.5% from where we are today. It seems like a minuscule number, but when you're dealing with the volume of what is it? How much? 1.5 trillion, I think. We'll look at coin market cap here. Yeah, $1.5 trillion. The dominance that represents is in the billions. Where did it go? So we are breaking out of that consolidation pattern. So it is debatable that it hasn't really broke this particular entry point. Is this the one? Yeah. There's this high here that arguably could be that consolidation range, within that consolidation range. So it is going to boil down to what can we do from here, right? If we do break above that, then Bitcoin dominance will continue, but at the same time, there is this big difference in what we're seeing. As Bitcoin dominance rises, typically speaking, we see this fall. So this is the total market capitalization outside of Bitcoin and Ethereum. So in short, all of the altcoins. it's been consolidating alongside Bitcoin dominance for quite some time. We zoom back out again. Bitcoin dominance has been consolidating basically since November of 2025. This one here, though, only consolidating since February. So while the dominance of Bitcoin is going up, we're not seeing a loss from altcoins, which means that money is flowing into both of them at the same time very well, on par even, in the sense that people are buying Bitcoin and then transferring that money into altcoins, holding on to Bitcoin as well.
Sounds like people are hedging their bets.
I don't know. This is again, this is going to be including data coming in from brokers or exchanges. And exchange traded funds have a huge influence over this. Because the exchange traded funds are largely applied to the coins within the top 20. XRP has an exchange traded fund. Solana, Doge, even a meme coin. Cardano can't be. It doesn't have the capacity of being manipulated, and so they have not applied ETFs, even though it's ranked 13. Stellar. I don't no, actually, I don't think Stellar has it. There was another one though that was down in here. I can't remember. But that those exchange traded funds, that is what's going to be leveraged by those exchanges to maintain a position. But we have to remember, smart money is that it's like they have sentience. They know what's going to be happening. So with Bitcoin dominance rising the way that it has been, and steadily for the past month, that same period of time, let's go this way. Yeah, in that same period of time, altcoins basically consolidating. That to me is an indication that those ETFs are holding here. They're not selling them, as in they're not offloading them. This tells me that there is an acquisition occurring. And the acquisition is for all of them all together, which is great. That's great for those who are anticipating growth here. Remember, our job is not to necessarily be the smart money, but to follow it. Smartest money is they just have sentient knowledge of what's going on. We don't have that, but we can identify how they and when they start accumulating. I'm going to make market analysis a little bit short today. Quickly going through the others. ADA bouncing off of this low here. This is C on the level of things. Market structure right now bouncing, dribbling like kind of like marbles. You know how When they bounce faster and faster. What does that look like? Well, we've talked about wedge patterns, right? So that energy buildup is going crazy right now. Likely to break out soon, given the trend line. We need to make this market structure color. If we can't hold this level, I have to move all of these lines, these rainbow colored lines. I'm gonna have to shift them down, probably by about 5 pivot points. If that occurs, then we'll likely see the next level be tested around 16 cents. So it may be advantageous for those that still have that are still holding ADA in a pattern that sell 25% maybe. Be ready for when that dip occurs. Might not. So be agile. Be agile with it. We would be looking, if it does go upwards, we would be looking at a pattern like this, where how come that's not shining? I don't know why that's not shining. So I will go back to this and use this instead. Going up, we would see a higher high than the previous coming back to test, at which point that's where I would start. I would actually start dollar cost averaging after the high. So after the high is formed, that's when you start dollar cost averaging, buying, and buying. But that if it were to go down, we will likely see that energy build up coming down like such, and that's where I would start planning on selling on the underside of that pivot point. So with market analysis happening every day, we'll be able to see this happen in slow motion and be able to adequately respond. Again, we're waiting for a confirmation. If we break out above, we will be placing buy orders to get it back on sale as it tests the top side. If it dips below, we'll be placing sell orders to catch it on the underside. Just because, I mean, if we go from 25 cents down to 16, can I even get there from here? Yeah, it's like 30% off. Because that's where that next pivot point is. 17 point, is that right? Nope, that's not the right number. 17.5. Next.
Can I ask a newbie question?
Yeah.
Because it sounds the opposite of what I would think, unless I don't understand the terms. So you're talking about people that already have ADA to sell it as it goes down and
Yep.
then pick it up as it. Aren't you then
Good.
like locking in a loss and then? I thought I understood this stuff, but this seems the opposite of.
Yeah. It seems counterintuitive.
Yeah.
I agree. I agree. The reason one would do this would be if they are looking to be more aggressive with their investment. There is a risk, for sure, but there's also a potential gain. And so when looking at that from this perspective, you wouldn't risk everything into a strategy like this.
Right.
Typically speaking, you're only going to risk about 25%. Saying, if I lose another 25%, of what I've already lost, it won't be that damaging. However, on the off chance that I can take that 25% and increase its yield in the long term,
Oh,
then it's worth it. Again, it's an aggressive strategy, but we have to
okay.
remember that most of the money made, it doesn't matter what type of market it is.
Right.
The most money that's made occurs in recovery.
Okay.
So right now, it's a 437% recovery.
Okay.
If it goes down below that and tempts these levels here, recovery is now 654%.
Okay.
So you're getting what is current, like if it works out, right? The risk is there. But if it works out, that 25% that you're risking, you're going to get it on sale for 26% off. That translates, that 25% will grow by 700% just in recovery. And the amount that it could do, that 25%, normally would just go 4x. So you're taking 25%, risking that, and potentially making almost as much as the other 75%. Simply because the dollar cost averaging strategy is where you make the most money in the long term.
So your dollar cost averaging out of it, selling it, you're not really going out, but you're repositioning. Could you say that?
Yeah.
Like maybe something that you bought at 40 cents, you're now making it. I guess I don't understand if you're already in it, why it makes sense to sell it, because isn't it the same if I got something at 50, what do you put there, $100, and it goes down and then it goes up again, how is that different than, or are you trying to skip some of the down, like selling it now and it might dip, you buy it and then it goes up? I don't even know if I'm making sense. But I think I'm starting to get what you're saying. You're doing it with so you dollar cost average selling, and then you would switch to dollar cost average buying on the way up.
You're on.
So the dollar cost averaging is consistent.
Yep.
And this is for like if somebody has a certain amount in it already and they're repositioning it. But if you don't already have money in it, or you have more to put in, this would be a good time to be dollar cost averaging, to either enter it or increase it.
Absolutely. If you have none and you intend to, it would not be worth the risk to wait.
Mm-hmm.
If you already have some, it can be very much worth the wait to sell and buy at that lower price. If you have money now and you don't buy now and the price goes up 10%, you're losing a lot. Someone who has been holding for a while, they're not losing anything by holding, but they may lose the gains that they could get
Right.
at getting things 20% off, 25% off.
So I may misunderstood too. So you're talking about selling and buying on the way down, like you're kind of going, oh, it's lower, oh, it's lower. I misunderstood that. I thought you were selling on the way down and then buying on the way up.
Got it.
But you're actually saying sell, and then as it goes down some more, buy some.
Yes.
Is that right? Okay.
Yeah, absolutely.
That makes sense to me. I misheard, so that's why it didn't make sense.
Oh, okay. Yeah.
as part of it, and part of it is that this is new to me.
Yeah.
So,
Yeah. Another way to look at this, and you're onto it, and I'm gonna say what you said in other terms, in another from another angle,
I love it.
but I'll be using real numbers. So let's say, for instance, you're gonna take 25%. So 400 is when you start, and you're taking $100 out, and you're saying, that $400 worth might go down. And it is going down right now because I just took out 100. So now I got $300 sitting in ADA and now $100 as US dollars. That's why we have ADA USD, because we're making these decisions based off of the currency pair, they call it. So with that $100 now, I'm going to sell it, but I'm going to take it and I'm going to move it so that I actually get what I would, if I were to buy that here, I would have to use $125 to get it before. But now I'm getting $125 worth of ADA. For some reason. There it is. So now that's 125. Now, that's because I got it at 30% off. Oh, so that's 30% off? We're going up. That's $130 worth. When it comes back up, it's going up in value 52%. It only went down 30. But because it's a smaller number, recovery is 52%. So that means coming back up, coming back up when it's back up to, I don't want to create another. As that asset comes back up again, now instead of 130, it's worth plus 65, that'd be 185. $185 plus 300. That $400 just made 20-some% because we bought it on sale with 25%.
I'm happy to report that I am tracking this.
Thank you. I'm glad. And the way that you explained it, I don't think that I would have been able to say that before you talked it through.
Oh, wow. Well, that's cool.
Because you bridged some wonderful gaps that allowed me to present that. Audrey Lynn, how are you feeling through this? What are some of your feedback? Because you've been in ADA now for quite some time, and you've even back in September, it was back in here that we were talking about. Probably we need to sell some, and you did. You took out 25%, and you bought back down again at 40% off. Now it's gone down. We didn't do it again. But you've experienced this kind of decision before.
So when you do that, like if you're giving this example that Audrey Lynn did, but didn't go back in and buy some lower, how does one
Here's how to look at what
navigate, like, oh, I'm going to still keep this out and wait because it's still going down, or I'm going to, I guess this goes into the whole thing of just having the knowledge that you have of the marketplace. Like I'm guessing that you saw, like, this is still going down. There's no reason to keep exchanging the position. Is that right? Or
I am expressing an idea that would be an aggressive investment strategy.
Okay, right.
I do not recommend people do this right out of the gate. I recommend that they get to experience the gut wrench of watching your account drop, so that the emotionality behind this kind of choice doesn't control you. And that sounds again counterintuitive and a little bit out there, but I can tell you that there is something that occurs inside your mind when it comes to taking risks. Recognizing that you might lose everything is the key to taking the risk with poise and with posture. Here's another way to expand on this idea. Let's say, for instance, it stayed at 400. And I'm going to change the color because now we're going to track 2 scenarios. And I'll make this one blue. Now this 485 is here. We're going with the scenario that we were able to take 25%, and we were able to leverage that and make 20% off of the 400. But from this location, we have to recover. And so recovery takes us back to the most previous high, or sorry, I should say most previous high, the high that started the decline. So this high here, this was from December 2024. When we go back to there, right now, that would result in a 429% recovery. Well, that means 4.29 times. So 400 times 4.29, that results in 1716. If it's 485, $4.14. Was that what I said? Oof. 4.3. So you got 2 different stories now. That $100 that made $85 has now made $300. That's where it's sometimes, especially for people who have that willingness to take on the extra risk. It doesn't make them better people. It's simply a strategy that you can use in the short term. Now, the reason why I like sharing this kind of example is because this can be done across years. This is the dollar cost average, the dollar cost averaging magic that can occur. That $100 made 3x on its way, while the other 300 only made 4x. So now you have taken less than half and amplified that to higher realms, because you're not coming from here, you're coming from here, coming upwards. So you're making almost 7x with 25% of your bag versus 4x. that 25% results in significantly larger leverage than the original. That's why someone would do this. The example that I like to talk about is with gold. I'm going to go to that daily chart. We're going to zoom out all the way. Oh no, I have to go to the weekly chart. We're going to zoom out all the way to when I started buying gold. When 10, 11, here we go. I started buying here. And it went down considerably. I kept on buying throughout from so 2011 I bought until probably in this realm here 2013. And yeah, people thought I was crazy. And then they knew I was crazy because I proceeded to lose. But I kept buying all the way into the beginning of 2014, probably into this area here, January. Yeah, I made my last purchase in January of 2014. I bought while it was going down. I bought at 20% off. So gold was 28% off from the time that I first started buying. And the amount that was purchased down here made money coming back. It took a while. Here's just before COVID. It took a long time to make it back. But when it did, although I bought at 28% off, when it recovered, that money made 40%. I feel like I'm saying the same thing and there is significance to it, and it's not landing as significant as it actually is. Probably because it's an experience.
Can I say a few things?
Yes, yes.
So, see if I'm hearing this right. Part of what, okay, I've got maybe three things, but for sure two things to say. One is, okay, let me figure out which one to say first. One is that you're showing how dollar cost averaging can work for people, period, in that you end up buying at all these different things. And I just thought it meant that you averaged out your price of what you bought it at, that was the benefit. But what you're also pointing out is that when if you're just dollar cost averaging all the way through, the ones that you buy at the lower prices are, in a sense, fulfilling the same function of being part of your investment that's gaining when it goes back up, that in recovery. But then you're saying also when you did this, it's like you stopped at a certain point. You didn't dollar cost average all the way. And so there's ways to be strategic about that too, that in general, I'm dollar cost averaging in right now. In general, I'm dollar cost averaging out, or I'm just pausing. So that's one thing I'm hearing. Is that based in reality?
Yes.
Okay. And then the other thing I'm hearing is, oh, shoot. Okay, here's the third thing, not the second. You're saying it's an aggressive approach, but someone can modulate how aggressive it is by how much of a percentage of their investment they put into it. At 25%, it's more aggressive than at 10% or 5%, where a person could also, even a new person, could start to gain the experience that you're talking about of not of finding a path that's not based on the emotion, but going through it on a small enough amount that it's not paralyzing, right? If someone had $100 and they do this with 10 of it and they lose that 10, okay, big deal. But you've still got to watch the chart and go, I made an investment and it's going down. So
Yep.
that was the third thing. And I don't remember what the second thing was at this point.
The only thing I would add, in order to see the correlation between, how I handled the gold and silver, I did it with both gold and silver during that time, and what I'm sharing with you as a potential strategy with ADA right now, is that this move is higher risk simply because of the time frame. This is the strategy that you can use, doesn't matter what time frame it is. It's that by doing it with short expectations, so for instance, we don't expect it to take long. When it recovers to these numbers that we're talking about, it's not expected to take a long time to recover. Whereas with the gold, although I was doing it thinking it wasn't going to take long to recover, because I had the mentality that the Great Reset was upon us, and that tomorrow just might be the day. The choices that I made, although they were made in the wrong context, they were not the wrong choices. The difference between what I explained about the gold and ADA is that what I'm suggesting is that you could, if you felt aggressive in that you would like to risk a little bit more, you could sell 25% and buy at a discount. My suggestion, though, is wait for confirmation. I did it without confirmations. I just went in all in, and I don't know how to describe that. It was just like it became an obsession. All in the sense that I was aggressive in investing it. I was not buying and selling at intermittent points, at faster time frames. I knew that I was in it for the long haul. Yeah, I still feel like
I'm tracking.
Yeah, okay.
You
I
weren't
go through it.
You weren't doing the repositioning for a short term. You were buying in thinking there was a short term that it was going to go up. It didn't.
Right.
It still was the right choices long term, but you weren't
Yep.
doing it with the right perspective. In hindsight, you couldn't know that going in, and probably not being as experienced as you are now.
Right.
Right. But even people that are experienced, it can go these ways, right? Like,
Indeed.
Things happen, the world changes, and it's like, ooh, that isn't doing what it seemed like it was going to. So I think I'm tracking.
I think what it is, and I'm as you're talking, I'm realizing more and more, what is my intention behind sharing this kind of strategy if it's really high risk, right? That it's a more aggressive, I shouldn't say really high risk, it's more aggressive. If you take that $100 out and it goes down and you don't buy, it's not like you lost money. Now it's $100.
Right.
It just doesn't go up in value.
You risked the opportunity by not buying.
Correct.
You didn't capture the opportunity, and you didn't capture the option for the opportunity.
Yeah. And that when it comes right down to it, I share the strategy on a short-term basis,
right?
So that people can recognize the long-term benefits of using the same strategy. I don't think that I don't think that there's 10% of the population that should do this unless they have that zoomed out perspective, and they would be able to agree that here's the gold chart. They would agree that buying gold in this area was not a mistake. Even though I lost, even if I wouldn't have dollar cost averaged, even if I never kept buying, buying at these high prices would still have resulted in a 200% growth.
Wow. Can you zoom out so we can see the height thing? The
Let's go to
height
the
thing. I'm
weekly.
so articulate. Oh
Yeah.
yeah. So that was the high part is over in that circle.
Yeah,
Yeah.
this was the part where I shouldn't have bought. I should not have bought because the prices were at all-time highs.
Right.
But yet I did, and even if I didn't dollar cost average, I still would have doubled.
Yeah. But you did dollar cost average part the way down.
Right. And that experienced a 300% growth.
Part of what this depends on, though, is that you were doing this in gold. You weren't doing it, say, in a stock, in a company, and then the company went out and you're just out.
Right.
Right.
Here's
So part of it is
here.
what is the vehicle that you are investing in?
This is another reason why I like to share with people that strategy, because what we're experiencing today is the result of what's called high frequency trading. The patterns are the same, they're happening at faster oscillations. When we take a look at the ups and downs of gold and you zoom in on it day to day, it actually looks more like a cryptocurrency chart across a week. I'm having a
Interesting.
difficult time with words today. It's like what we're seeing occur in crypto is as if we had zoomed in on gold. So we are experiencing micro movements. The same types of things that gold would do across years, we're seeing cryptos do within weeks sometimes. And so as a result, you may experience the benefit of applying a 2-year strategy within a month. That's, yeah.
And that is
And
very
it's
cool. That is very cool.
It's
For a
because
number of reasons.
it's digital.
Right. And not just because it's of the investment made, but the learning process. Like you can also, what do you call it? Not shrink, condense that learning experience.
Yeah.
That rather than learning over 5 years, you could learn in 3 months. It's like, or go through it. Maybe learning isn't even the right word, but like go through it and get an embodied sense of what that's like.
Yeah, that's a good way to put it. You're going to see the same patterns that I experienced across a decade. When this takes off, the same thing will have occurred within a matter of years instead of like 13 to 18. That was, or 11 to 18. That was 7 years. Almost, yeah. So largely a decade. This will occur, that same thing will have occurred within 2 years, I think. Let's go look. Yeah. actual measurements. Yep, 505 days. That's something that took gold 1,500 days. And that the recovery on gold took 1,600 days. Oh, that's not recovery. Recovery is, oh yeah, no, that's basically recovery. And then gold consolidated. After that, gold consolidated for, we'd have to call that 1,200 days. And everything since that consolidation has all occurred within 787 days. And what we will see is this kind of accumulation. We're going to see that in crypto within a shorter time frame. 789 days, it's almost 2 full years. No, it is. It's more than 2 full years. February 2024 to April 2026. When this happens, it's going to occur much faster, simply because this decline, instead of 1,500 days, this was 500 days. And, that 780 days will likely be condensed to, again, 1/3 of that when it happens. It's going to be quite sudden. Probably around the 160 to 180 days, I would imagine. That's why I talk about the strategy, because the time frames are condensed within the digital world. In 1990 is when people started getting computers in their living rooms so that they could access the internet at will. Within 3 or 4 years of that, high frequency trading became something that anybody could just go and buy software to go do in their living rooms, if that was of interest to you. High frequency trading became an anomaly to all of the foreign exchange, where the volume of trading tripled within a year, just because people were able to do it from the convenience of their homes. Now, because of cryptos, you can do high frequency trading in the palm of your hand. It's just an app. It's a free app even. You really only pay for the transactions that go back and forth. And there are even some brokers that will lend you 10 times what you deposit, just charging you the transaction fees on the 10 times. As such, the movements within crypto, like this price pattern here that's not really that amazing. Like this is market structure here. We haven't left market structure for a long time. But that would be if we're looking at a chart that typically, foreign currencies or gold and silver, this kind of price action would normally occur across decades of time. Look at that price action. How volatile that is. If we were to zoom in, how volatile that is, that's something we don't normally see in things like metal, unless, let's go back to gold, unless we look at that weekly chart and zoom all the way out and look at it from 1972. right? In fact, I'll go to the monthly chart just so that we can see. That's how far out we have to zoom to see the volatility. This is the monthly chart. And here is when the gold standard got kiboshed. 91x.
Is that 1933 or 19?
This was the
13?
Nixon, the
Oh.
Nixon era.
Oh, right. No, I'm
1972.
thinking, sorry. Right. So that was 1970?
Yep,
60?
1972.
All right.
And so that is the type of thing that we will see in crypto, but it will be occurring in years instead of decades. As such, the dollar cost averaging strategy is going to provide people with the most returns. And typically, that strategy is something that is used across a long period of time. We are going to be applying in short bursts. Follow Next Gen Merchants for more.
Awesome session, even though I missed the first half hour.
Oh, that's all right.
Still totally totally gold, so to speak.
Thank you. Well, that ended up being a lot longer of a market analysis than I expected. Thank you. It was good practice for me to help share why I'm sharing this kind of strategy. It is aggressive and it is risky, and it is the most appropriate approach considering the time frame that we're in.
Mm-hmm.
Thank you, everyone. Have a good rest of the day.
Thank you. Excellent.